In December 2001, America's seventh largest corporation, Enron, declared bankruptcy, with $63 billion vanishing and thousands of careers obliterated overnight. This is the Enron story, a company that conjured billions from thin air and collapsed spectacularly while the world stood and applauded. Enron began in 1985 as a mundane natural gas pipeline operation, born from a merger that only industry insiders noticed. Then came Kenneth Lay with a PhD in economics and a revolutionary idea: deregulation. He envisioned transforming Enron from a sleepy utility into an energy trader, where natural gas was bought, sold, and speculated on like stocks. Lay recruited Jeff Skilling, a sharp McKinsey consultant who believed Enron was a technology company selling the future of energy. Wall Street embraced this vision, especially with the launch of Enron Online in 1999, a digital platform that made energy trading effortless. Fortune magazine crowned Enron America's most innovative company 6 years running, fueling an electric and cutthroat atmosphere within the company. Skilling instilled a message of being the smartest people in the room, leading to massive bonuses and casual backstabbing. Enron branded itself as a market maker and tech disruptor, but its actual operations were often shrouded in buzzword-filled explanations. The stock price continued to climb, reaching over $90 by 2000, a 1,200% gain in 3 years, making it a Wall Street darling. However, behind the celebrations, the math wasn't adding up, as energy markets couldn't sustain such constant, spectacular growth. Enron bent the rules using mark-to-market accounting, booking all 10 years of projected profit from a contract immediately. This made Enron appear like a money-printing machine on paper, even though many deals were barely profitable or based on overly optimistic projections. When numbers still didn't cooperate, CFO Andy Fasto created special purpose entities, technically separate but controlled by Enron. Enron would sell its worst assets to these SPEs, making it appear to offload risk and generate cash. But in reality, Enron funded both sides of the transaction. While Fasto juggled liabilities, top executives cashed out millions in bonuses and stock options, enjoying private jets and vacation estates. Meanwhile, regular Enron employees were told to pour their retirement savings into Enron stock, losing everything when the company collapsed. Wall Street analysts continued to give Enron glowing reviews, often working for firms doing lucrative business with Enron, compromising objectivity. By 2000, Enron's image seemed bulletproof, but the truth was buried under layers of jargon and misleading spreadsheets. In August 2001, Jeff Skilling abruptly resigned as CEO, a red flag the size of Texas. That same month, the SEC launched an investigation into Enron's off-balance sheet entities, signaling trouble. Kenneth Lay returned as CEO, downplaying concerns, while Vice President Sharon Watkins warned him of an impending accounting scandal. Persistent journalists and analysts began asking critical questions about Enron's confusing business model and mysterious entities. In October 2001, Enron publicly admitted to accounting errors, revealing $586 million in overstated earnings. Investors panicked, and the stock collapsed from nearly $90 to under $1 by the end of November, losing 99% of its value. On December 2, 2001, Enron filed for bankruptcy, a financial catastrophe that wiped out $63 billion in assets. Thousands of employees lost everything, while executives like Skilling, Lay, and Fasto had already cashed out millions. Arthur Andersen, Enron's auditor, was supposed to be the financial watchdog, but instead profited from consulting fees. When investigators circled, Andersen destroyed thousands of documents, leading to their conviction for obstruction of justice and the firm's collapse. Banks like JP Morgan, Citigroup, and Merrill Lynch also facilitated Enron's off-books deals, receiving hefty fines but no criminal charges. Skilling was sentenced to 24 years in prison. Fasto received 6 years, and Lay died before serving his sentence. The Sarbanes-Oxley Act was passed in response, mandating CEO certifications and auditor independence. The Enron scandal was a story about belief and illusion, about what happens when the world wants to believe something so badly that they stop asking questions. For 16 years, Enron sold the future, but when the lights came on, the building was hollow, the numbers were fake, and the smartest guys in the room had vanished.